Hi everyone, this is Mrs. V Chen. Welcome to my Form 4 Accounting lesson number 13. Today is 8th of April 2020. Okay, so we will look at some of the examples about depreciation. And here is the first example. Let's say at the beginning of year 1, so we purchased this motor vehicle at the costs, which is 153,000, and then we pay by check. All right, and today's method for depreciation is this. So use straight line method, and then at the rates of 10%, and also we have this 3,000 as the residual value. Okay. All right, so on 1st of January, we have this double entry showing we pay the money to buy motor vehicle, and 153,000 is the costs. Okay, so after we have used the motor vehicle for a year, the value of motor vehicle will decrease, so that at the end of year 1, we need to provide depreciation, and this is a double entry, same as before. We debit depreciation in the profit and loss account, so you can see depreciation is a kind of expense, and then we credit accumulated depreciation. All right, so to calculate, we use straight line method and saying that this 133,000, which is the costs. All right, so minus the residual value. All right, so what is meaning of residual value? This is exactly the value of the motor vehicle at the end of the useful life. When we are no longer using the motor vehicle, we can sell it and then we can get back 3,000. So this is residual value. And then we have some more names for residual value. Residual value is same as disposal value. All right, or sometimes we call it scrap value. Okay, all right, so therefore the formula here using straight line, this is the rates. Okay, the rates times costs minus residual value, so that how much will be depreciation? So that will be 133,000 minus 3,000, the residual value, and then times 0.1. Okay, so in the first year, the value of motor vehicle dropped by 15,000. Okay, so after the double entry, okay, let's look at the posting or the T accounts in year 1, so that we have depreciation account. So this is in year 1. Okay, and remember, this is the nominal account, and this is a real account, same as before. So since this is year 1, we don't have any opening balance to begin with. Okay, so the double entry will be debit depreciation. Here I put 15,000, right, and then we provide that at the end of year 1, and this is because of accumulated depreciation. So that I go to this credit side, year 1, and then that is 31st December. So I also have 15,000 here. It is because of depreciation. This is the posting. Okay, and since depreciation is nominal, therefore this 15,000, okay, so at the end to be close to profit and loss account. So therefore in my income statement, this is a T form. I have this on debit side, which is expenses, and this is depreciation in the income statements, or the debit side in the profit and loss account. All right, and now here, since accumulated depreciation is a real account, so that I will have this closing balance 31st December balance carried down. So this closing balance will be opening balance in year 2. All right, now this is the statement of financial position. I have my motor vehicle. So how much is the cost? 153,000. Okay, and now this accumulated depreciation is a real account, and also it is a credit item. So this is debit, so put them together, so minus 15,000. Okay, therefore I can get my net value as this: 153,000 minus 15,000. So this is my net book value in year 1. So next, let us repeat everything like depreciation, accumulated depreciation, this in year 2. All right, so since accumulated depreciation is a real account, so since we have this closing balance last year, so I'm going to have this. Also, this is year 2. So year 2, I have this opening balance to begin with. So that will be closing 15,000. So I have 15,000 here to begin with. All right. Okay, hold double entry. So in year 2, we always provide depreciation at the end, at the year end, so that we debit depreciation. Straight line method, the same amounts. So 31st December, because of accumulated depreciation, so debit depreciation and credits. Accumulated depreciation, so I have another 15,000, and this is because of depreciation, right? Okay, so now let us close this. So close this because this is nominal accounts. I close this to profit and loss. Okay, so therefore I will have in the income statement or profit and loss account on debit side. Here I have another depreciation in another year, year 2, 15,000. Okay, now let me close this accumulated depreciation. So altogether I have 30,000. This is 30,000 and closed at the end, the last day, so balance carry down 30,000. Okay, so here I have the cost, which is always the same, the purchase the price 153,000, and accumulated depreciation going up to 30,000. All right, so I have my net book value in year 2. Okay, drop more, 133 minus 30,000, drop further to 123,000. Okay, so we use the same information in example 1, but now we jump to year 9. So this accumulated depreciation, so which is the real account, so I should have opening balance. So year 9 and year 9, so the beginning of year 9, so balance brought down. But the point is, since we jump and then we don't have the closing balance in year 9, therefore, how do we work out this accumulated depreciation? So that will be, I have my costs. Right, this is the cost 153,000 minus the residual value. Okay, times the rates 10%, and then times, since this is year 9, that at the beginning of year 9, that means we have used this for 8 years. So times 8, so used for 8 years. Therefore, this is how I calculate the opening balance in year 9. So 133 minus 3,000 times 0.1. So each year, the depreciation is 15,000. Now, it has been used for 8 years, so times 8. So I have this 120,000 to begin with. Okay, and then after that, I just follow the usual thing. So year 9, provide depreciation at the end. So that is 15,000 each year because this is using straight line method. Reason is accumulated depreciation, so debit depreciation and credits accumulated depreciation because of depreciation. So that is 15,000. Right, okay, and now I close this 15,000 the end to the profit and loss account and loss. Okay, as usual, so 15,000. So here I have my depreciation, right? And non-current assets, motor vehicle is 153,000. The costs, the purchase, the price, and now I need to close this. So that will be 120, the closing balance, 120, yes, plus 15,000. So I have 135,000, right? So 135,000 and 135,000. So the end is 31st December, and this is balance carried out. So therefore I have this 135,000, right? So 153 minus 135, so I get 18,000, and this is the net book value. So, and actually we can prove this 150,000, is that right? Okay, because each year, so how much is the depreciation in each year, which is 15,000? And this is in year 9. So in year 9, that means we have used this for 9 years. So times 9. So let's check. Yes, which is exactly the same. So we can always prove that. So for this accumulated depreciation. All right, so after that, we come to year 10. So as usual, so we have exactly the same thing in the depreciation account. So we have this 15,000 because of accumulated depreciation and close to profit and loss like this. Okay, and in the accumulated depreciation, and then last year we have this as closing balance. Right, so this will be opening balance to begin with. And then in year 10, I provide another 15,000, right, because of depreciation. Okay, so altogether I will have 135,000 plus another 15,000, so therefore I have this 150,000, so 150,000, and this is also 150,000, and then 31st December balance carry down. Okay, so finally, what do we have as non-current assets in the statement of financial position? This is the cost, 153,000, and minus altogether 150,000, so 150. So therefore, I have this 3,000. Finally, as net book value in year 10. Okay, so this is year 10, and the net book value is 3,000. And remember what is meaning of 3,000? 3,000 is exactly, okay, as the residual value of the motor vehicle. All right, so if you compare with this in the previous lesson, all right, so this time we don't have 0 for net book value for fully depreciated. However, the net book value in year 10 is 3,000. Okay, and then another thing is we are using straight line method, and then if you go to your textbook on page 162, you get this meaning of straight line method, which is by which the costs of non-current assets is written off evenly here. So that means each year we provide the same amounts of depreciation. Okay, and then over is estimated useful life. Now here in this example, 10% actually is same as 10 years. Okay, so this is using straight line method. That means depreciation in year 1 is same, 15,000, right? Depreciation and profit and loss account same. And year 2, so this is year 1, right? And then year 2, so how much is depreciation in year 2? Also, in the profit and loss account, we have the same amounts. So that is straight line method. Okay, and also in year 9, here we also have depreciation, which is same because we are using straight line method, and in year 10, which is also the same straight line method. So the keyword for straight line method is this. Okay, the cost of non-current assets is written off evenly, the same in each year over its estimated useful life, and 10% is same as 10 years is the useful life. Okay, now we have example 2. So we have the similar situation. Now we have motor vehicle purchased at the same price, and this is the cost. But now I just changed straight line method this time to reducing balance method. Okay, so this is reducing balance method, and then at the rates of 10%. So how do we use reducing balance method to calculate depreciation? So it will be equal to the net book value times the rate, and the rate is 10% here. Okay, so same as before, we debit motor vehicle and credit bank means we pay money to buy this motor vehicle. And now we always need to provide depreciation at the year end, and here is the same double entry. Okay, and however, since now we use reducing balance method, so that will be the rates times the net book value. Since this is in year one, so that the costs will be same as net book value in year one. Therefore, so how much depreciation? 133,000 times 0.1. So that I have this 15,300, 15,300. All right, so after the double entry here, we have all the T accounts in year one. And since this is year one, we don't have any opening balance in the accumulated depreciation account, so that we just do this debit depreciation, credit accumulated depreciation, and close this to profit and loss account, right? And here, this is the closing balance, and accumulated depreciation accounts is the real account, so that we have this. In the statement of financial position, this is the purchase price, the cost, motor vehicle, and then we minus this 15,300. So therefore, we get this net book value in year one as this 137,700. Okay, so next we have year two, and here, oh, this is year two. This is year two. All right, and this time we have opening balance in year two. Actually, it will be the closing balance in year one. So I have this to begin with, 15,300. All right, so to provide depreciation, the double entry is this here. At the end, this is year two. This is year two, so 31st December. And then the reason is accumulated depreciation. But the point is, how do we calculate this? We use reducing balance method, saying that it will be the net book value in year one times the rate, which is 10%. And how much is net book value in year one? Here I have this net book value, so that would be 137,700 times 1%. So I just cancel 1 0 here, 13770, right? Okay, so this is the method we use here in example 2, using reducing balance method, and this is the formula. Okay, so to close this, so 13770, so close to profit and loss. Okay, so I have in the profit and loss 13,770 because of depreciation in year two, right? And then the posting, this will go to here, credit 13,770, and then we always provide depreciation at the end because of depreciation. Okay, so altogether, so how much do I have here? So I will have this 15,300 plus 13,770. So I have 29,070. So 29,070. This is 29,070. 31st December, and this is the closing balance, right? Okay, so statement of financial position. This is the cost of motor vehicle, and now I have the closing balance 29,070 as the accumulated depreciation. So how much left? So I will have this as net book value in year two. So you can see we are now using reducing balance method. Okay, let us compare depreciation in year one. So this is depreciation in year one, 15,300. However, in year two, we have less amounts of depreciation than last year. So that's why we call this reducing balance method. Okay, now in year three, we also have the opening balance, which is the closing balance in year two. So that I have this closing in year two, 29 and 70. So this 29 and 70 to begin with. Okay, and now we need to provide depreciation in year three. Okay, so this is because of accumulated depreciation. And then how do we calculate that? Again, this is year three, so we need the net book value in year two times 10%, which is the rate Is that right? So how much is net book value in year 2? So here I have my net book value in year 2. So 123,930. Okay, so the amount will be 12393. Okay, all right. So that I need to credit this account 12,393. Okay, so at the end, so this is because of depreciation, right? Okay, all right, so let's close this 393 to the profit and loss account. Okay, so I have 12,393, the depreciation expense in year 3. Okay, so altogether accumulated depreciation going up to 41,463. So 41,463 and the end balance carry down. Okay, so here I have 41,463. So how much is net book value in year 3? Therefore, I have this net book value in year 3. I put 3 here. Okay. All right, so let us jump to year 10. And also we need to show everything like depreciation accounts and accumulated depreciation account. But the point is, how much is the opening balance in year 10? Since we don't have any information in year 9, so therefore we need to go back to the previous information and see whether we can get some pattern. So the depreciation in the first year, we have this costs times 10%. So we have this 15,300. And in year 2, so since this is reducing balance method, so we have the rate times the net book value. And the net book value in year 1 will be the cost minus this, right? So therefore we will get 133,000 minus 15,300 times 0.1. So I have 13,770, right? And this is what? This is 10%, right? So that the whole thing after minus 10%, so that what is net book value? Net book value will be equal to costs times 90% left times 10%. So this is the pattern. So therefore we have this. This is the net book value in year 1. Okay, all right, so let's move on to depreciation in year 3. So the pattern will be net book value year 2 times 10%. So therefore, how do we get this net book value in year 2? So that would be costs times 90% times another 90% and then times this, right? So therefore I will have 153,000 times 90% square 2 times 10%. So therefore I have this 133,000 times 0.9 times 0.9 times 0.1. So the answer of depreciation in year 3, so which is 12,393. Okay, look at the value here, and now I also have my depreciation in year 3, okay, which is exactly same as 123,930. Is that right? So that we can form this net book value. So we can say if we use reducing balance method, so the net book value will be equal to costs times, all right, so let's say in year end, that will be 1 minus the rates, okay, the percentage to the power n. So we can work out this formula by looking at this pattern. Okay, now I can calculate depreciation in year 10. So that will be net book value in year 9 times 10%. To get net book value in year 9, that is the cost 133,000 times 90% to the power 9, okay, times 10%. So that I use calculator 153,000 times 0.9 to the power 9 gets answer, and then times 0.1. So that this is depreciation in year 10, that would be 5,928. So round off to the nearest dollar. So I have this 5,928. Is that right? So 31st December. Okay, you can see accumulated depreciation account going up by another 5,928. And then how about the opening balance? The opening balance is accumulated depreciation. Okay, so look at this. If you know the costs, you know net book value, then the difference is accumulated depreciation. Is that right? So I can do this by simply look at the difference. This is the costs. Okay, minus the net book value. This is the net book value in year 9. Okay, minus 133,000 times 0.9 to the power 9 to get the opening balance. So therefore I have this 153,000 minus 153,000 times 0.9 to the power 9. Okay, so my opening accumulated depreciation will be 93725. All right, so 93,725. Okay, I use another calculator. Okay, so 93,725 plus 5928. So 99653, 99653, and 99,653. 31st December balance carry down. And so in year 10, I have this 99,653. Okay, all right. So this is net book value in year 10. Okay, and also I close this 5,928, close this to profit and loss. So that depreciation in the income statement in year 10 will be 5,928. Okay, so since we work out the formula already, is it possible that we prove this net book value in year 10 by using formula, which is the cost 153,000 times 90% to the power 10. Okay, to prove whether we have everything correct or not. So 153,000 times 0.9 to the power 10. Yes, so 5, 3, 3, 4, 7. Okay, all right. So what is the conclusion? The conclusion is, in this example, we are using reducing balance method, and then we work out the formula of net book value. So where is the formula of net book value? Here, this is the formula of net book value, which is equal to costs times 1 minus the rates to the power n. Alright, so finally let us make comparison between straight line method and reducing balance method. So this is using reducing balance method, and we still have this 53,347 in year 10 as the net book value. However, if you go back to straight line method in the first example, so we have 10% using straight line method, and the net book value is 3,000, which is exactly same as the residual value, and that is in year 10. Okay, and then 10% is same as 10, the life is 10 years. So therefore, for reducing balance method, we can still move on to year 12. Okay, and then in year 12 we have this net book value equals to 43,212. Okay, and how do we calculate depreciation in year 12? So same as before, that would be net book value in year 11 times the rates after minus the rates 0.9 to the power 11, like that. And this is the opening balance for accumulated depreciation. Is that right? Okay, and if you follow this, you can still provide depreciation to year 12, year 13. All right, to unlimited years actually, if you compare this with straight line method. But for straight line method, if it is 10%, actually year 10 is the final year that you need to provide depreciation. Okay. All right, so the final thing, all right, to finish today's lesson. So if you go to page 164, you will find reducing balance method, and which is the method of the costs of a non-current assets is written off as depreciation at a diminishing rate. Okay, so therefore each year we provide less depreciation than the previous year, because the formula is this: depreciation using reducing balance method, the rates times net book value. And also we have this formula to get net book value by using reducing balance method, which is cost times 1 minus the rate to the power n to get net book value in year n. All right, so that's all for today's lesson. Thank you for watching my video. I'll see you next time. Bye bye.